I was looking at the charts this morning, and honestly, it feels like I'm watching some sort of psychological thriller rather than financial news.
Oh, absolutely. It's definitely twitchy right now.
Twitchy is an understatement. I mean, you know that feeling when the protagonist in a movie is just completely losing their grip on reality? That is the stock market right now.
Yeah, a severe identity crisis.
Right. It feels like the market has developed a split personality. One day we're all popping champagne because AI is going to solve all our problems, print infinite money. And the next day, the Dow drops like over 800 points because someone realized interest rates might stay high for another 20 minutes.
And that volatility is really just the symptom, not the disease. What you are seeing is a market that fundamentally doesn't know which story to believe anymore.
And that is exactly what I want to dig into today for this deep dive. Because usually, there's a consensus reality. Everyone agrees things are booming, or everyone agrees we're heading into a recession.
Right, a unified narrative.
It's exactly. But right now, we saw cybersecurity stocks lose $52 billion in market cap in just 48 hours, based on essentially a single viral thesis.
And a thesis that wasn't even from a major banking institution. It was a post on Substack that just completely caught fire.
Exactly, a blog post.
Yeah.
And then the very next day, we see this massive relief rally. So the mission for our deep dive today is to figure out for you, the listener, what is actually going on. Is this just noise? Is it standard technical volatility? Or is the market actually sensing a tectonic shift that we just aren't seeing on the surface?
I strongly lean toward the latter. I think we are looking at two massive colliding narratives. It's like two weather systems just smashing into each other.
A financial hurricane.
Precisely. On one side, you have this AI apocalypse narrative, and I don't mean Skynet launching nukes. I mean the deflationary collapse of the white-collar job market.
Right, the robots taking the high-paying jobs.
Yeah, exactly. And then crashing right into that, we have what I'd call the macroeconomic perfect storm. We have Jamie Dimon, the CEO of JP Morgan, pointing out 6 very specific red flags that suggest the broader economy is walking right into a trap.
So on the left, we have tech is moving way too fast, and on the right, we have the old economy is drowning in debt.
That's the setup. And the whiplash you're seeing on the charts is the market trying to price in both of those potential catastrophes at the exact same time.
Okay, let's unpack this. I want to start with the AI side first because, well, that's where all the drama was this past week.
It certainly was.
This viral Substack theory that tanked the software stocks. What was the core argument there? Because, I mean, we've heard AI is coming for your jobs for years now. Why did the market decide to panic over it this specific week?
The panic came from the specificity of the claim. Until very recently, AI was just this vague cloud of potential for most investors. But this thesis focused on a highly specific capability.
Which was?
AI agents handling complex legacy code. Specifically, the argument was about the ability of advanced models like Anthropic's Claude to autonomously read, fix, and maintain COBOL.
Wait, TOBOL. Like the programming language from the 1950s.
The very same.
I genuinely thought nobody used that anymore.
That is a very common and very dangerous misconception. COBOL is basically the zombie of the global financial world.
It just won't die.
It won't. It runs the back end of almost every major bank, insurance company, government agency. We are talking about systems that process trillions of dollars a day.
So it's basically the rusty plumbing in the basement of the entire economy.
That's a great way to put it. And here's the kicker, because it's so incredibly old, and the human engineers who originally wrote it are mostly retired or, frankly, deceased, it is incredibly risky to touch.
I can imagine.
You change one single line of code in a massive bank's mainframe, and suddenly ATMs in 3 different states stop dispensing cash.
So companies like IBM must charge an absolute fortune to maintain it, just because they're the only ones who still know how the plumbing works.
Exactly. It forms a classic economic moat. IBM and a few others make billions on these long-term, locked-in consulting contracts because the switching cost, the risk, and the sheer effort of moving a bank off of COBOL is just impossibly high.
It's a localized monopoly built entirely on fear and friction.
Yes. But now, enter the AI agent.
Right. Okay, I see where this is going. If an AI agent can read that ancient code, understand it instantly, and rewrite it into a modern language like Python or Rust without making any mistakes.
Then that massive moat just dries up overnight. The viral thesis argued that if AI turns code migration from, say, a $100 million 5-year consulting nightmare into a $500 SaaS subscription that finishes over the weekend, you aren't just saving a bank some money.
You're destroying the core asset value of every consultancy that relies on that friction.
Exactly. It's massively deflationary. You are permanently taking billions of dollars of corporate revenue right out of the system.
But the thesis went deeper than just IBM, right?
Much deeper. The argument expanded to say that if AI can replace those highly paid white-collar workers, the senior developers, the cybersecurity analysts, the folks making 200 grand a year, you suddenly hit a massive demand problem in the broader economy.
Because those are the exact people who buy the new houses, lease the nice cars, take the expensive vacations.
Right. Software agents don't buy tickets to Disney World. They don't go out to eat.
So if you lay off the high spenders, aggregate demand drops.
And when companies see their sales dropping, what do? They invest even more heavily in AI to cut costs and protect their profit margins.
Which just leads to more layoffs.
Exactly. It becomes a deflationary spiral. That was the fear that wiped out $52 billion in market cap in 2 days. Investors looked at companies like Visa, MasterCard, ServiceNow, DoorDash, even Blackstone, and thought,
wait, if the upper middle class loses their jobs to software, who on earth is using all these premium services?
exactly. The growth models for all those companies assume a thriving, highly paid professional class.
But then we got the whiplash. Because literally the very next day, the market rallied hard. I saw software ETFs go up 2%, Reuters was up 11%, Salesforce jumped 4.5%.
It was a massive swing.
So was the market just wrong the first day? Or did they forget about the deflationary spiral?
I wouldn't say they were wrong, but they were reacting to a sudden counter-narrative. The very next day, Anthropic announced new plugins specifically for investment banking and wealth management.
But the key was how they framed it, right?
Precisely. They framed these AI tools as partnerships with existing legacy firms, not as replacements for them.
The whole co-pilot framing. Here to help you, not fire you.
Right. So the market took a collective breath and said, okay, maybe the AI doesn't completely replace the bank or the consultancy. Maybe it just sits on top of the existing companies.
The outline referred to this as the orchestration layer theory. Can you explain how that works in practice?
Sure. Think of the current enterprise software landscape as a really messy toolbox. A big company uses Salesforce for customer management, SAP for finance, Workday for HR, Slack for communication.
And none of them talk to each other very well.
Exactly. It requires a lot of human labor just to move data between them. The orchestration layer theory says that AI acts as the ultimate conductor. It doesn't replace Salesforce. It just uses Salesforce for you.
So IBM keeps its big contracts, Salesforce keeps all its enterprise subscribers, and the AI just sits in the middle, making everyone, 10% more efficient?
That is the highly optimistic status quo view that caused the relief rally. But I have to tell you, the original viral thesis touched on something else, something much more profound than just who writes code, that I really don't think the market has fully digested yet.
You're talking about the lazy premium.
Yes. The imminent end of the lazy premium.
I saw this in our source notes, and it really stuck with me. Because, well, when I look at my own credit card statement every month, I am definitely paying a lazy premium on at least 5 different subscriptions I forgot to cancel.
We all are. It's human nature. But the thing you have to realize is that the entire modern service economy is essentially built on that exact human flaw. Think about banking. Why do the major retail banks pay 0.01% interest on a savings account when you could easily get 5% in a treasury money market fund?
Because moving money is incredibly annoying. You got to research a new broker, open a new account, verify your identity, link the bank accounts, wait 3 days for the transfer. It takes an hour of active work.
Right, and that single hour of friction is worth literally billions of dollars in pure profit to the big banks every year. They are making a massive bet on your laziness.
They're betting that the switching cost is just barely high enough that I'll stay put and accept a terrible deal.
It is a tax on your inertia.
A tax on inertia. I like that.
And it's everywhere. Insurance companies, cable providers, SaaS platforms, they all heavily rely on stickiness. Their entire business model knows that once they have you onboarded, they can slowly creep up the prices or slowly degrade the customer service, and you probably won't leave because finding a new provider is a hassle.
But enter the AI agent.
Enter the agent, because an AI is never lazy.
It doesn't get bored.
It doesn't get frustrated sitting on hold with Comcast for 3 hours.
So in this future scenario, I basically have a personal AI agent that monitors my car insurance rates every single month in the background.
Every single month, down to the penny. And the exact second a competing insurer offers the exact same coverage for $10 less, the AI just switches you automatically.
Wow.
It cancels your unused streaming services, it constantly renegotiates your internet bill, it moves your cash to wherever the yield is highest that day.
That sounds absolutely amazing for me, the consumer. But for the companies.
It is a total nightmare. It completely destroys the economic moat of customer inertia. If the friction of switching providers drops to zero, then every single digital service essentially becomes a pure commodity.
So companies would have to compete purely on price and actual value every single second of every single day.
Yes. And if they have to do that, corporate profit margins would absolutely collapse.
That is the true deflationary threat of AI, isn't it? It's not just about replacing the coders or the analysts. It's about ruthlessly stripping away all the fat in the economy that corporations currently label as profit.
Exactly. It makes the market perfectly efficient, and perfect efficiency means zero excess profit.
Okay, let me play devil's advocate here for a second. If this deflationary spiral is so obvious, massive white-collar layoffs combined with collapsing corporate margins, why isn't the stock market crashing right now? We're still sitting near all-time highs.
Because there is a massive counterforce fighting against that deflation, and that force is the federal government.
The money printer.
Always. History shows us very clearly that modern governments simply do not tolerate deflation. Deflation increases the real burden of debt, and our governments are drowning in record amounts of debt.
Right, if dollars are worth more tomorrow, your fixed debt becomes harder to pay off.
Exactly. So if AI actually starts causing massive systemic unemployment, the political pressure to do something is going to be unstoppable.
We're talking universal basic income, massive stimulus checks.
UBI, stimulus, massive infrastructure projects, whatever name they want to give it. It's fiscal stimulus. If the private sector stops spending money because the AI took their jobs, the public sector will just step in, print the money, and spend it for them to keep the gears turning.
But printing all that money creates inflation.
Exactly. Which brings us perfectly to the second massive narrative we need to cover. We've talked about the deflationary tech shock. Now we need to look at the inflationary macro shock.
The Jamie Dimon warning.
Yes. While everyone in Silicon Valley is arguing about whether robots will take our jobs, Wall Street is looking over at the bond market and seeing a slow-motion train wreck.
Jamie Dimon, the CEO of JP Morgan, arguably the most connected banker in the world, said he sees a combination of signals right now that he hasn't seen since the months leading up to the 2008 financial crisis.
That is a very heavy comparison coming from him. He doesn't say things like that lightly.
And he gave a timeline, right?
Yeah.
6 to 18 months for this to play out. So we need to dig into these 6 specific signals he identified, because I want you, the listener, to understand that this isn't just some vague doom and gloom prediction. These are mechanical, mathematical breaks in the financial system.
They are structural red flags. Let's go through them.
Okay, signal 1, the yield curve inversion. Now, I feel like financial news anchors absolutely love throwing the phrase yield curve around, but nobody ever actually stops to explain why it matters to a normal person.
It sounds incredibly technical, but conceptually, think of the yield curve as the collective wisdom and fear of millions of bond investors. Simply put, the yield curve tracks the difference between short-term interest rates, like a 3-month Treasury bill, and long-term rates like a 10-year Treasury bond.
And in a normal, healthy world, the long-term bond pays more interest, right? If I lock my money up for 10 years, I'm taking more risk on inflation and default, so I demand a higher rate of return.
Correct. That slope upward indicates a healthy, growing economy. An inverted yield curve is when short-term rates actually pay more than long-term rates.
Which is exactly what we have right now.
And we have had it for over 18 months. What this mathematically tells you is that bond investors are so terrified of the near-term future that they are rushing to buy long-term bonds just for safety.
Driving the long-term yields down.
Exactly. They are essentially making a multi-trillion-dollar bet that the Federal Reserve is going to have to panic and crash interest rates soon to save a dying economy.
But wait, people have been pointing at this inverted yield curve for a year and a half now, and we haven't had a major recession yet. Is it possible the signal is just broken this time?
Well, that is the trillion-dollar question that the soft landing crowd is banking on. They say, this time is different. The economy is strong enough to handle high rates. But historically, the yield curve indicator is 8 for 8.
Wow.
It has predicted every single major recession in modern history without a single false positive.
So betting against it means you are betting that this time is different for literally the first time in a century.
Right. And the truly scary part isn't just that it's inverted, it's the duration of the inversion. This current inversion has actually lasted longer than the ones that preceded the 1929 crash, the 2001 dot-com bust, and the 2008 housing crisis. The spring is coiled tighter right now than it has ever been in our lifetimes.
Okay, so that's the abstract bond market signal. Let's move to something highly visible. Signal 2, commercial real estate distress.
Ah, the refinancing wall.
Right. I mean, anyone walking around downtown San Francisco or New York knows the offices are empty. Occupancy is still 30 to 40% below where it was before the pandemic.
But the underlying problem isn't actually the empty desks, it's the calendar.
The loans are coming due.
Exactly. Commercial real estate loans aren't like your standard 30-year residential home mortgage. They're usually much shorter term, 5 or 10 years max, with a massive balloon payment due at the very end. You essentially have to refinance them when the term is up.
And these building owners, these massive commercial landlords, they originally took out these loans years ago when interest rates were sitting at 0.
Precisely. They bought these glass towers, assuming money would be cheap forever. But now we are looking at $2.5 trillion in commercial loans that absolutely must be refinanced in the next 3 years.
And they have to refinance them at current rates.
Right. They are going from a 3% loan to a 7 or 8% loan, all while their specific building is generating 30% less rental income because of remote work.
The math just literally doesn't work.
It is literal insolvency. JP Morgan's own internal estimates suggest that up to 40% of these commercial properties cannot mathematically survive refinancing. The landlords are just going to throw their hands up and hand the keys back to the bank.
They'll just default. And when they hand the keys back, who exactly is the bank left holding the bag?
That's the real systemic risk. It's usually not the giant, too-big-to-fail banks like JP Morgan or Bank of America. It's the regional banks. The small and mid-sized community banks across the country hold the vast, vast majority of this toxic commercial debt.
Which feels like the perfect segue into signal 3, consumer debt stress. Because if those regional banks get in trouble, they have to stop lending money to everyday people, right?
That's right.
But I keep seeing headlines saying the American consumer is doing great. Consumer spending is up.
Spending is up in nominal terms, yes, but you have to ask how they are spending that money. That's the vital distinction.
It's all in plastic.
Credit cards. What we are seeing is a severe bifurcation of the economy. The top 20%, the people who own stocks, real estate, assets, they're doing fantastic. The wealth effect from the market being up makes them feel rich, so they spend.
But the bottom 80%.
They have completely burned through whatever savings they had from the COVID stimulus era, and now they are just fueling their daily lives with expensive debt.
I read we're at record levels of credit card debt across the board.
Over $1 trillion nationally. And keep in mind, the average family now carries about $6,000 in revolving credit card debt.
At what, 20% interest?
Averages are over 20% now, yes. But the real flashing red flag Jamie Dimon pointed to is delinquency. People missing their payments. We're seeing a very sharp spike in defaults, particularly in auto loans.
Why are auto loans the canary in the coal mine here? Why not mortgages?
Because in America, outside of a few major cities, your car is your absolute lifeline. You need it to physically get to work to earn a paycheck. Psychologically and economically, people will stop paying their credit cards, they'll skip utility bills long before they ever stop paying for their car.
Because if the car gets repoed, it's game over.
Exactly. So when you see auto defaults rapidly rising, specifically among younger borrowers, it means the tank is completely empty. They aren't just managing cash flow poorly, they are actively having to choose between the car payment and buying groceries.
Unlike 2008, which was hyper-focused on subprime mortgages, this feels like systemic stress across all forms of basic consumption.
It's a broad-based squeeze. The consumer is only looking resilient on paper because they are aggressively running up a tab they have no ability to pay off.
Okay, so let me pause and synthesize this. If the everyday consumer is tapped out and the bond market is predicting a major crash and commercial real estate is literally collapsing, why do corporate earnings still look so decent? I still see earnings season headlines touting record profits.
Ah, that is signal 4. And honestly, this is the most fascinating one because it is the most deceptive. It's what the source calls the corporate mirage.
So the earnings are fake.
Not legally fake, but artificially manipulated through financial engineering. You see, the primary metric Wall Street and algorithms care about is EPS, earnings per share.
Right. Total profit divided by the number of shares outstanding.
Exactly. Now, there are two distinct ways a CEO can increase that EPS number to make the stock go up. Route 1, actually make more total profit. Sell more widgets, innovate, expand. That is very hard to do in a slowing economy.
En route to
Reduce the denominator, reduce the number of shares. That is very easy.
stock buybacks.
Stock buybacks. S&P 500 companies have spent over $3 trillion buying up their own stock over the last 5 years alone.
$3 trillion. That is a staggering amount of capital.
It is. Now think about what that $3 trillion didn't do. It
Right.
didn't build new manufacturing plants. It didn't fund long-term research and development. It didn't go toward increasing worker wages or bolstering the balance sheet for a rainy day.
It was literally just burned to artificially inflate the current stock price.
Yes.
But why are they so obsessed with it? Just to make the chart look good for investors.
It's pure incentives. If you are the CEO of a Fortune 500 company, your massive end-of-year bonus is almost entirely tied to hitting a specific stock price or an EPS target. If you can guarantee hitting that target just by using the company's cash, or worse, borrowing money to buy back shares, you do it. You secure your multi-million-dollar bonus, the major shareholders get a temporary pop, and everyone is happy.
Until the actual bill comes due.
Until you realize you've completely hollowed out the foundation of the company. You have sacrificed the company's long-term competitiveness for short-term stock performance. And now that interest rates are sitting at 5%, borrowing cheap money to fund those buybacks is getting incredibly expensive.
So the financial sugar high is wearing off. It really feels like we are ripping the copper wiring out of our own house just to pay this month's mortgage.
That is a brutally apt analogy. You're cannibalizing the structure to keep up appearances.
Which leads us right into Signal 5. We briefly touched on this with the regional banks and the real estate, but I want to go deeper. The banking sector hangover.
Yeah.
We had that very scary mini crisis back in March of 2023, Silicon Valley Bank, Signature Bank going under. The Fed rushed in, created a special lending facility, and patched it up. Are we saying that patch didn't actually fix the core issue?
We're saying it was essentially a Band-Aid placed over a gaping bullet hole. The crisis was delayed, not solved. The core mathematical problem that took down Silicon Valley Bank was unrealized losses on their bond portfolios.
Walk us through that mechanism again, just so everyone is clear on how a bank actually loses money on safe bonds.
Sure. Banks take your cash deposits and, to make a yield, they invest a large chunk of it in historically safe assets, primarily long-term U.S. Treasury bonds. But when the Federal Reserve hiked interest rates aggressively from basically 0% up to 5%, the market value of all those old low-interest bonds absolutely crashed.
Because logically, nobody in the open market wants to buy a bond paying 1% when they can just buy a brand new one paying 5%.
Exactly. So the market asset value drops 20–30%. But under very specific banking accounting rules, the banks don't actually have to officially report that loss on their balance sheet as long as they promise to hold the bond all the way to its maturity date years from now.
So it's an unrealized loss. It's just a loss on paper.
It's Schrodinger's loss. It isn't technically real until you are forced to look at it.
But if the depositors get spooked?
Exactly. If rumors start or a tech sector panic happens and depositors demand their cash back all at once, a classic bank run, the bank doesn't have the cash sitting in a vault. They are forced to sell those underwater bonds today on the open market to raise the cash.
And suddenly that paper loss becomes a very real, very realized loss.
And the bank's capital evaporates instantly. They are technically insolvent. That is exactly what killed SVB.
And Diamond's warning is that these regional banks are currently sitting on mountains of these underwater bonds. Plus, they hold all those bad commercial real estate loans we talked about earlier.
It's the ultimate double whammy. They are getting crushed from both sides of their balance sheet. Their safe assets are devalued by high interest rates, and their loan books are going to be decimated by the commercial real estate crash.
It seems incredibly fragile.
It is remarkably fragile. And then finally, we have signal 6. The one signal we have absolutely the least amount of control over, geopolitics.
Right. I mean, the world is quite literally on fire right now.
We have a grinding war in Ukraine, severe instability in the Middle East, ongoing trade tensions and posturing in the South China Sea.
But from a purely economic perspective, why does Diamond single this out as a macro financial risk rather than just a political one?
Because of supply chains.
We all saw what happened during COVID. When the supply chains broke down, you couldn't get a couch, you couldn't get microchipped, and prices skyrocketed.
Exactly. Broken supply chains equal instant inflation. But what we are facing now is arguably structurally worse. You have rebel attacks on shipping lanes in the Red Sea, forcing cargo ships to reroute around the entire continent of Africa.
which adds massive fuel costs and weeks of delay to every single container.
Right. You have escalating tariffs, sanctions on energy, countries hoarding critical minerals. All of these geopolitical actions structurally and permanently increase the basic cost of moving goods around the planet.
And higher costs get passed to the consumer as inflation. Which brings us right to the trap you mentioned at the very beginning of the show.
The Fed's absolute worst nightmare.
Walk us through the trap.
Normally, if the U.S. economy cracks, say the commercial real estate market implodes and banks start failing, the Federal Reserve has a standard playbook. They drastically cut interest rates to make money cheap and stimulate economic growth.
But if they cut rates right now,
Inflation is already simmering just below the surface because of these massive supply chain issues and government deficit spending. If the Fed cuts rates, they pour pure gasoline on that inflation fire. We could easily see inflation shoot back up to 8–9%.
but if they don't cut rates,
If they keep rates high to fight the inflation, then the regional banking sector collapses under the weight of those underwater bonds, commercial real estate defaults cascade, and the over-leveraged consumer completely drowns.
so they are well and truly damned if they do and damned if they don't.
That is the textbook definition of a macroeconomic trap. They have essentially lost the ability to use their primary policy tool without catastrophically breaking something else.
Wow, okay, this is heavy. I want to zoom out for a second for the listener, because we've listed these 6 signals like a checklist: yield curve, real estate, consumer debt, corporate mirage, banking hangover, geopolitics. But they aren't just isolated items on a list, are they? They interact with each other.
They absolutely do. That's what we call systemic risk or a systemic feedback loop. And honestly, this is the specific scenario that keeps institutional risk managers awake at 3 in the morning.
Let's walk through that domino effect.
Yeah.
How does this actually play out in real time?
Okay, let's trace the path. Imagine domino 1 falls tomorrow. Commercial real estate. A major institutional landlord formally defaults on $1 billion worth of empty office towers in downtown Chicago.
Okay, they default, the bank takes the loss.
Right. Domino 2. The specific regional bank that held that commercial loan is forced to take a massive write-down. Their quarterly earnings look terrible, their stock tanks. Depositors see the news, get scared, and start pulling their uninsured deposits out.
A localized bank run.
Exactly. Domino 3. To survive the run, that bank, and crucially, every other regional bank watching this happen in real-time panics, they completely stop issuing new loans to preserve their cash reserves.
A severe credit crunch.
Yes. So the local small business owner suddenly can't get a bridge loan to make payroll. The everyday consumer gets their credit card limit slashed from $10,000 down to $2,000.
And we just established the consumer is surviving entirely on credit.
Domino 4. Consumption drops off a cliff. Remember, consumer spending makes up roughly 70% of the entire U.S. economy. If the credit dries up, the spending immediately stops.
People stop eating out, they stop buying new phones, they cancel vacations, and if spending stops,
Domino 5. Corporate earnings absolutely collapse. Revenue dries up. And because they've spent all their cash on stock buybacks instead of building a safety net, they have no buffer. The buybacks can't hide the fundamental rot anymore.
and when corporate earnings miss their targets, the CEOs panic to protect the stock price.
And the mass layoffs begin, which is domino 6.
And once the layoffs start, the newly unemployed consumer defaults on their auto loans and their residential mortgages, which inflicts even more losses on the banking sector.
And the loop closes, it feeds on itself and accelerates.
And because the Fed is structurally trapped by sticky inflation, they can't just swoop in like a superhero and print $4 trillion to freeze the system like they did in March 2020.
Not without intentionally turning the US dollar into confetti, no. Their available ammo to fight a crisis is lower right now than it has been in decades.
All right. I think we have sufficiently terrified everyone listening to this deep dive.
It is a sobering picture.
We've painted a scenario where a deflationary AI tech shock is colliding head-on with an inflationary debt crisis. So the logical, practical next question for you, the listener, is what do you actually do with your money?
Right. We absolutely cannot just leave people curled up in the fetal position.
Please don't.
Our source material actually discusses a very specific tactical investment philosophy designed specifically for this bizarre environment. It uses an acronym that investors are starting to adopt. HALO.
HALO. Okay, what does HALO actually stand for?
It stands for heavy asset, low obsolescence.
Heavy asset, low obsolescence. Okay, break that down for me.
The core foundational idea here is to aggressively pivot your portfolio away from things that are vulnerable to being disrupted by AI and simultaneously away from things vulnerable to financial engineering and debt traps.
So stay far away from bits.
Exactly. Stay away from purely intangible assets. If a company's entire valuation is based on proprietary code or intellectual property or brand sentiment that could theoretically be replicated or eroded by an autonomous AI agent in 2 years, that is an incredibly risky place to park your wealth. HALO is about moving capital back into the physical world.
We're talking about atoms.
Atoms, yes. Physical reality.
Give me some concrete examples of a heavy asset.
Think about energy infrastructure. Power grids. You literally cannot download a power grid. You cannot ask ChatGPT to generate a physical copper mine in Chile.
It's the old rocks and wires thesis.
Exactly. Physical pipelines, massive industrial data centers. I mean, the actual concrete buildings, the land, and the specialized cooling systems required to run the AI servers, not just the software itself. Heavy agriculture, defense manufacturing. These are incredibly heavy assets. They require billions of dollars and decades to permit and build.
They have massive physical barriers to entry. You can't just have two kids spin up a competing copper mine in their Silicon Valley garage over the weekend.
No, you can't. And that physical moat protects your investment. And the low obsolescence part of the acronym means investing in things that humanity will absolutely need in 50 years, regardless of what technology does.
Right. Whether we are driving flying cars or riding horses, we will still need electricity. We will still need protein. We will still need industrial metals.
Exactly. It sounds like a traditional rotation from growth stocks into value stocks, but it's much more extreme than that. It is fundamentally a rotation to basic survival.
A flight to quality.
Yes. You are already seeing the smart money, the institutional capital, quietly moving out of vulnerable consumer discretionary sectors and rotating heavily into defensive sectors.
Like utilities.
Utilities, healthcare equipment, consumer staples.
Things people buy because they physically have to, not just because they want to.
Right. Even in a severe economic depression, people still buy toothpaste. They still buy basic medicine. They still pay their electric bill to keep the lights on. Those corporate cash flows remain highly resilient even when the broader economy is contracting.
What about cash? Because with inflation, cash is usually considered trash. But right now, cash is yielding 5%.
Cash is absolute king right now. The overwhelming advice from macro analysts is to build and hold significantly larger than normal cash reserves, specifically holding it in short-term government bonds like treasury bills.
Why specifically short-term?
Because of that inverted yield curve we talked about, you are literally getting paid 5% risk-free by the government just to sit on your hands and wait. It gives you the ultimate investor superpower optionality.
Because if the stock market does crash 30% next month, you have the dry powder ready to go in and buy those halo assets at a massive discount.
Precisely. If your money is locked up in tech stocks that just crashed, you can't take advantage of the fire sale.
The outline also made a very distinct point about geographical decoupling. Basically, moving your money out of the United States entirely.
This is a somewhat controversial play, but it's becoming crucial. Look, for the last 10 to 15 years, the USS and P500 was essentially the only game in town. It massively outperformed every other market on Earth.
Mostly driven by big tech.
Exactly. But now, with U.S. equity valuations sitting so historically high and the domestic debt risks we just spent 20 minutes discussing, global capital is actively looking for safer, cheaper homes elsewhere.
Where is money going?
A lot of it is flowing into emerging markets. India is seeing huge inflows as a demographic and manufacturing alternative to China. But interestingly, we're also seeing capital flood into developed markets that have basically been asleep for decades. Japan is the prime example.
The Nikkei have been hitting record highs recently after, 30 years of complete stagnation?
34 years, yes. Warren Buffett himself has been aggressively buying up Japanese trading houses.
If Buffett is buying Japan, people should probably pay attention.
They absolutely should, and Europe too. These international markets are fundamentally cheaper on a valuation basis. They have a much higher concentration of those value and halo stocks, traditional banks, heavy energy, industrials, and far fewer wildly overhyped software stocks.
So it's a diversification play. It's
Yeah.
a hedge against the U.S. dollar specifically and U.S. domestic policy risk.
It is. And finally, when talking about decoupling from the US dollar, we absolutely have to talk about the shiny rock.
Gold.
Gold and silver, they have been quietly but very aggressively rallying for months now.
Now, whenever someone brings up gold, my mind immediately goes to, doomsday preppers burying bullion in their backyard.
Mhm.
Is this rally just retail fear?
Not at all. It's institutional, and more importantly, it is sovereign. Central banks around the world, the central banks of China, Russia, Poland, India, are physically buying gold at record historic rates.
They're actively diversifying their national reserves away from the U.S. dollar.
Exactly. They saw the U.S. weaponize the dollar system with sanctions, and they are hedging their bets.
So the logic is, if the biggest central banks in the world are hedging against the dollar and buying physical gold, maybe the everyday investor should take the hint.
Gold is the ultimate heavy asset. It's an atom, not a bit. It has zero counterparty risk. If a regional bank fails, or the digital financial system freezes up over a weekend, an ounce of gold is still an ounce of gold.
It's insurance, not an investment.
Perfectly stated, it won't pay you a quarterly dividend, but it will preserve your purchasing power if the currency devalues.
Okay, let me summarize the playbook for our listeners. Get physical with halo assets, get defensive with utilities and staples, look abroad for cheaper valuations, and hold some real hard money like cash and T-bills and physical gold.
That's the framework. But perhaps even more importantly than what you buy is how you think about it. The source material stresses adopting a mindset of process over prediction.
Process over prediction. What does that mean in practice?
It means accepting with humility that we absolutely cannot know the timing of any of this.
Yeah, the market can stay irrational longer than you can stay solvent.
Exactly. We know the yield curve is inverted. We know the commercial real estate debt is a ticking time bomb. But we don't know if the bomb goes off next Tuesday or in 2027.
So don't just liquidate your entire 401k, short the SP 500 and sit in a bunker waiting for doomsday.
Do not try to be a hero and call the exact top. Timing the market is a fool's game. Instead, focus entirely on your process. Look at your portfolio today. Are you properly diversified? Do you have adequate cash reserves to weather a storm? Do you own physical assets that have intrinsic real-world value?
If the answer is yes, you can mentally detach. You can weather the storm whenever it eventually breaks.
It's about building robustness. Nassim Taleb calls it anti-fragility.
I like that.
Fragility is the ultimate enemy right now. Corporate financial engineering creates immense fragility. Relying entirely on cheap debt creates fragility. And as we discussed, AI disruption creates sudden fragility for highly specialized knowledge workers.
So your primary job right now, both as an investor allocating capital and, frankly, as an individual navigating your career, is to build personal anti-fragility.
Exactly. Build a life, build a skill set, and build a portfolio that can take a heavy punch and stay standing.
Because the punch is definitely coming. We just don't know if it's going to be a left hook from an AI-driven deflationary shock or a right hook from a macro-inflationary debt crisis.
Or, heaven forbid, a simultaneous kick to the gut from both directions at once.
Stagflation on steroids.
That would be the worst-case scenario.
Well, we have covered an absolutely massive amount of ground today on this deep dive.
Yeah.
I mean, we went all the way from the archaic COBOL code, quietly running the global banking system, down to the physical gold bars sitting in foreign central bank vaults.
It all connects. That's the beauty and the terror of macroeconomics.
It really does. I want to leave you, the listener, with one final, slightly provocative thought, something for you to chew on as you go about the rest of your week.
Lay it on them.
We spent a lot of time today talking about this fundamental shift from bits back to atoms, from the hyper-financialized digital world back to the gritty physical world.
Yeah, the core of the Halo strategy.
And we talked about how generative AI is rapidly going to drive the basic cost of knowledge down to near zero. Writing boilerplate legal contracts, writing basic code, analyzing standard spreadsheets, all of those high-paying cognitive tasks are essentially becoming free, commoditized software features.
The intellectual lazy premium is evaporating.
Exactly. So the provocative question you need to ask yourself is this. In a future world where advanced AI fundamentally devalues your brain power and your digital skills, and simultaneously massive government debt devalues your fiat currency.
What is left?
Exactly. Do you personally own enough heavy assets, enough tangible, physical, undeniable reality to actually survive the shift?
That is the ultimate question for the next decade. When the music finally stops and the digital mirage fades, what are you actually holding in your hands? A speculative digital token or a productive piece of the earth?
Bits or atoms? It's a sobering thought. I think as soon as we finish recording this, we're going to look up the current price of arable farmland.
Honestly, that is not a bad idea at all.
Thanks for joining us on this deep dive, everyone. Look at your portfolios, stay safe out there in the markets, and we will catch you on the next one.
Take care, everyone.